This is Analyzing Transactions video number 5. All right, so today we're going to focus on this video, we're going to focus on withdrawal, also known as the drawing account. So I'm going to do a quick review down here at the bottom. Assets equals liability plus owner's equity. We have our debit, credit, and then we have our owner's equity section of accounts, which is expense, sales, drawing, also known as withdrawal, and capital. This side is debit and this side is credit. So the focus here is the drawing account. Okay, so the drawing account is an account that the owner takes money out of the company for personal use. Okay, so this is when we use the drawing accounts. Okay, when the owner takes money out of the company for personal use. Okay, so that's the focus of today, the drawing account. So we're going to analyze a transaction. We're going to analyze a transaction on page 47 in our Southwest edition of Southwest edition 10 textbook for accounting. So we're on page 47, January 16th. And the transaction reads, Michael Delgado, that is the owner of the company, Michael Delgado withdrew equity in the form of cash. Michael Delgado withdrew equity in the form of cash. So Michael Delgado is the owner of the company. So we're looking at transaction on page 47. And it is for date January 16th. Okay. So we need to know the two accounts that are affected. And it is Michael Delgado withdrew equity. So if Michael Delgado withdrew equity, that means he took money out of the account for personal use. It doesn't say like he took money out to buy a company truck or anything like that. So he just took it out to do whatever he wants to do with it. So because that's the case, one of the accounts that is going to be affected is the drawing account. And it says he withdrew equity in the form of cash. So cash is the other account. So the two accounts affecting is drawing and cash. So where does drawing fit into the accounting equation? Well, drawing is part of owner's equity. It's part of the four accounts that make up owner's equity. So it is owner's equity. And where does cash fit? Cash is an asset. What is the normal balance of owner's equity? Normal balance of owner's equity is credit. What is the normal balance of an asset? It is debit. So based off this transaction, do I have more or less owner's equity? Do I have more or less owner's equity based off of this transaction? So drawing is on the debit side of the owner's equity accounts. The normal balance of owner's equity is credit. Normal balance means to increase. It's how an account is increased. So if we debit the account, that is the opposite of owner's equity's normal balance. So that means we will have less owner's equity based off this transaction. So that is a minus. So do we have more or less cash? Well, we took money out of the account. So money went away. I'm sorry, we did not take money out of the account. Michael Delgado took money out of the account. Remember, we always read transactions from the perspective of the business. So Michael Delgado is the owner. However, we are the business. We focus on the business. So in this situation, Michael Delgado is almost like a person who we would spend money on. So because he took money out for personal use, that means money went away from the company, so we have less money. So minus means we do the opposite of the normal balance, so that is a debit. Minus, we do the opposite of the normal balance, that is a credit. So then, which account do we debit? Because we always do debits first. Based on this, we debit the drawing account and we credit the cash accounts. So I'm going to analyze this transaction again, but I'm going to do different here in the accounting equation portion based off of how it fits into the owner's, I'm sorry, how it fits into the owner's equity group of accounts. So we'll start over. We're on page 47. It is January the 16th. And the transaction reads, on January 16th, Michael Delgado withdrew equity in the form of cash, $350. So that is the transaction. Michael Delgado is the owner. We know the two accounts affected are drawing and cash. So what we're going to do different here is the owner's equity portion. So instead of just doing owner's equity for drawing, we're going to do owner's equity / drawing, which lets us know that we're focusing on the drawing normal balance, not the owner's equity normal balance. Okay, so in that case, and this is an asset, so in that case, the normal balance here is going to be debit because we're focusing on the normal balance of drawing, which is debit, not owner's equity, which is credit. Okay, and so our cash is still an asset, which has a normal balance. So now we read it. Do we have more or less drawing? And we have more drawing. The drawing account has more in it because the owner took money out for personal use. So that increased the drawing account. So that is a plus. Do we have more or less cash? We have less cash because money left the company. So we have less cash. So now we have a plus here. So it's plus. We do the same as the normal balance. Minus, we do the opposite of the normal balance. So what account do we debit? We debit the drawing account. And we credit cash. So as you can see, no matter how I did this portion, this changed, but our end result becomes the same because of how we read this portion. So we need to make sure that we never end up with two debits or two credits in the end. When we get to this change column, you can never have two debits or two credits. You can only have one debit and one credit at all times. You can never have two debits and two credits if we only have two accounts. One has to be a debit and one has to be a credit. Okay? Thank you.